Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sise, your tutor and your mentor. Today, we are going to complete IFRS 16. So, we are going to look at the accounting treatment for sales and leaseback transaction under IFRS 16. Now, let's understand the concept about sale and leaseback. For instance, I own a basketball team. I have my pitch where I used to train my players, and also I use the pitch to play matches. So now it's fine. Due to some financial challenges, I decided to sell that particular pitch of playing. So now, but at some point in time, after I have made the sale, I want to have the right to use that particular pitch again. So I decided to go into a lease agreement to the individual that I sold the pitch to. So in this situation, I have made the sales to the buyer. Then also, I have requested to have the right to use that particular field, that particular pitch again. So this is what we refer to as a sale and a leaseback. After I have made the sales to the buyer, then I decided to go into a lease agreement to the same buyer again. So in this situation, I will become the lessee because I am the one that will have the right to use the property. So basically, we are going to look at how we can account for the sales and how we can account for the lease back. Very simple concept. We are going to look at how we can account for the sale and how we can account for the lease back. So we need to blend it together, the sale and lease back. So now, according to IFRS 15, if there is a sale, according to IFRS 15, revenue from contract with customer, then we are going to apply the sales and lease back concept. But if there is no sale, then we are going to treat this as a secure loan under IFRS 9. We are going to look at it separately. And yes, IFRS 9 will be the next topic, the next accounting standard I'm going to cover. So now let's go in depth into the concept of sales and leaseback. If an entity, the seller, the lessee, as I mentioned earlier, initially I am the seller. I sold the property, I sold the pitch to the buyer. Then thereafter, I decided to go into a lease agreement to have the right to use that same property. So I am the seller and the lessee. Transfer an asset to another entity, the buyer and the lessor, and then leases it back from the buyer. The seller and the lessee must assess whether the transfer should be accounted for as a sale. So the first point of understanding is that we need to know whether the sale is in line with IFRS 16, if it is actually a sale rather than a secure loan. So we need to note this point down. For this purpose, the seller must apply IFRS 15 revenue from contract with customers to decide whether the performance obligation has been satisfied. Very important point. If there is a sale, then it's fine. We are going to recognize the sale. We are going to, we are going to de-recognize that particular asset in our financial statement. At the same time, we are going to recognize a profit or loss on the disposal if there is a sale according to IFRS 15. This normally occurs when the buyer obtains control of the asset. Control of the asset refers to the ability to obtain substantially all of the remaining benefits. In financial reporting, sales proceeds will only ever represent the fair value of the asset. Very important point. When for financial reporting, when we're talking about the sales proceed, it means the fair value of the asset that will be given in the question. So when fair value is given in the question, then we need to know that this is the sales proceed. This is the cash that we are going to receive as a result of the sale that we are going to make to the buyer. So this is the concept that you need to understand. When we are talking about a sales and lease back, if the transaction is a sale according to IFRS 15, then we are going to account for it as a sale. Then we are going to account for the lease back transaction in a separate manner. So now let's go further and try to understand. Transfer is not a sale. In a situation where the transfer of ownership to the buyer is not a sale, then what are we going to do? How are we going to account for short transaction? If the transfer is not a sale, then the seller, the lessee, continues to recognize the transferred asset and will recognize a financial liability equal to the transfer proceeds. Now, in a real sense, as I initially mentioned, I own a basketball team, right? I own the pitch as well. But due to financial difficulty, I did not sell the pitch to the buyer, which is clear. But because of financial difficulty, I need money. So I decided to put the pitch as a collateral, to place the pitch as a collateral so I can secure fund so that I can able to expand in my business operation. In this situation, this is not a sale. So if this is not a sale, then what how are we going to do? We are going to continue the recognition of this specific asset in our financial statement. Plus, we are going to recognize the financial liability. When we are going to look at IFRS 9, we're going to understand the definition of financial assets as well as financial liability. But what you need to know, if the transaction is not a sale, then we are not going to account for it as a sales and lease back. Instead, we are going to continue the recognition of the assets and we are going to recognize a financial liability because we took out, we give the property as a collateral to secure fund. So therefore, the amount that we are going to secure, we need to recognize it as a liability because it is an obligation that we need to ensure we comply with. So we need to recognize it as a liability. In simple terms, the transfer proceeds are treated as a loan. Note it down. The detailed accounting treatment of financial asset and financial liability is covered in IFRS 9. So don't worry. For now, you need to assess the transaction whether it is a sale or not. If it is not a sale, then what are you going to do? You are going to continue the recognition of the pitch, for example. You are going to continue the recognition of the assets because the control will not be transferred to the person that is going to provide the loan. Plus, we are going to recognize a financial liability. Very simple. First point to know. Second condition, if the transfer is a sale, if the transfer meet the condition according to IFRS 15, then automatically what are we going to do? This is the important point that you need to know for the sales and the lease back. If the transfer does qualify as a sale, then the seller, the lessee, when I'm talking about the seller, the lessee, this is the person that initially owned the property but decided to dispose the property to another party, then at the same time decided to go into a lease agreement to have the right to use that same property. So it is the seller and the lessee must measure, very important point, must measure the right of use assets as a proportion of the previous carrying amount that relates to the right retained. So we need to measure the right of use assets. So when we are going to calculate the right of use assets, the calculation will base on the proportion retained. So we need to calculate the proportion retained. So now let me make the note. So right of use assets will be calculated based on the proportion retained. Now, what do I mean by proportion retained? Very important concept. Initially, I own 100% of the pitch, as I mentioned earlier, the basketball team. I own 100% of the team and the pitch. But I sold the pitch to the buyer. I have transferred 100% of the control to the buyer. I have in no situation I have any control to that pitch anymore. So 100% disposal, which is fine. But I decided to lease the particular property. The lease will give me the rights to use the asset, not the ownership anymore. Very point. We need to create this distinction. We need to make the distinction very clear. The lease agreement will give the seller initially the rights to use the asset, but not the ownership. So we need to assess the proportion of right that is retained as a result of the lease agreement. We need to determine that proportion. So for us to calculate the proportion, we are going to look at the lease liability divided by the sales proceed. So now the proportion retained is equals to the lease liability divided by the sales proceeds, the amount that we are going to receive from the sale, multiply by 100. This will give us the proportion retained. Then also the difference in percentage will give us the proportion that we did not retain. Very important point. The proportion retained, we are going to use it to determine two important aspects. So now let me make a note. Note the proportion retained will be used to calculate one, the right of use asset. Second point, the profit or loss on disposal. So this is the reason why we need to determine the proportion retained, because we are going to use it to determine the profit or loss on disposal. Very simple. So now, the initial value of the right of use asset is therefore the lease liability divided by the sales proceed multiplied by the previous carrying value. This is how we're going to apply the retain, the proportion retained. We are going to multiply it against the previous carrying value of the assets. Because initially, the carrying value of the asset is what's stated in your financial statement, not the value, not the new value. The new value is with the buyer. So we have nothing to do with it. So we are going to account for the right of use assets using the previous carrying value because that value has been the value stated in our financial statement. So this is the reason why we are going to multiply the previous carrying value by the proportion retained to give us the right of use asset. So this means that the seller, the lessee, will recognize a profit or loss based only on the right transfer to the buyer or the lessor. I've made it clear. So now, only we are going to recognize profit or loss on disposal if it is a sales, if there is a sales, if the control has 100% been transferred to the buyer. So we are going to recognize profit or loss on disposal. So basically, this is the concept. Another point we need to know when we are going to account for the leaseback transaction, we are going to do it in the same manner, nothing to worry about. In our previous lecture, the initial and the subsequent recognition for the lessee accounting is what we are going to use to account for the lease agreement. So now we are more curious and concerned about how we can account for the sales and how we can account for the lease back during the sales and the lease back transaction. Very important concept. So now we are going to look at this illustration 4, and this will help us to very good. So we are going to solve this question. Required. Explain how B will account for the transaction on 1st January 20x4. 1st January 20x4. We want to know how we can account for this transaction at the sales and the lease back date. On 1st January 20x4, B sells an item of equipment to F for its fair value of this. So let's collect some data, right? Let's collect data. So data, sales proceed equals to $1 million. This is the sale proceed, right? The equipment had a carrying value. So the carrying value is equals to $800,000 before the sale. These sales represent the satisfaction of a performance obligation in accordance with IFRS 15 revenue from contract with customers, which is clear. So we need to go ahead and recognize the sales. We need to account for the sales transaction according to IFRS 15. B enters a lease contract with F for the right to use the equipment for the next 4 years. So the lease period now, the lease term will equals to 4 years. Very clear. The lease term will equals to 4 years, right? Annual payment, we are going to calculate the annual payment. Annual payment, which is the cash payment, will equals to $200,000. And the interest rate implicit in the lease agreement. So we are going to take the interest rate. Interest rate equals to 9%. Finally, the present value of the annual lease payment. So present value of lease payment is equals to 650. Very good. So now the remaining useful life of the machine is much more greater than the lease term, which is fine. That's not our problem. So now we need to account for the sale first, then thereafter we can consider the lease back. Very good. So let's handle the sale. So now, on normal ground, the proceeds is greater than the carrying value. So there is a profit on disposal of 200. But we are not going to use that 200 because we need to determine the percentage, the proportion retained. So now let's calculate the proportion retained. The proportion retained, which is equals to the lease liability divided by the sales proceed multiplied by 100. So now um, the lease liability is 650. So 650,000 divided by 1 million multiplied by 100. So this will give us 65%. So we have retained 65%. So now we are going to calculate the right of use asset. Right of use asset, which will equals to 65% multiply by what? What are we going to multiply the 65% by? The previous carrying value. The previous carrying value of the asset. Why? The reason being is that the value of the asset is what initially has been used to recognize the asset in the financial statement of the seller. So we need to use that same value to recognize the proportion retained. So this will be 65% times the previous carry value is 800,000, which will equals to, let me use my calculator, my phone, sorry. 0.65 multiplied by 800. So it gives us 520,000. Very simple. So now we need to calculate, sorry. We need to calculate the profit. So we need to calculate the profit. So profit or loss on disposal will equals to, if 100% sales is made, then we retain 65%. So automatically the profit will be 1 million minus the 800 multiplied by the difference in the percentage retained, because the remaining percentage, which is will be what, 25%. The remaining 25% is what actually we made the sales on. So 25%. So automatically this will be 200 multiplied by 0.25. Sorry, this is 25%, or let me, it should be 100 minus 65 in percentage. 100 minus 65. Right, it's supposed to be 35%. So 35%. So now it will be 200 multiplied by 35%. This will give us the profit. 200 multiplied by 0.35. It will be 70,000. This is the profit. Now we need to do the double entry. We need to account for um the lease liability. So the lease liability will equals to, given in the question, the lease liability is what? The lease liability is um annual. The lease liability is 650. Very good. And the annual payment is 200. So now this is all what we need to do for the sales. We don't have anything to worry about when it comes to the lease back. This is all what we need to do for the sale. Now, if we are going to account for the lease back transaction, we are going to do it the normal way in our previous session. Normal way in the sense, we need to recognize the lease liability and the right to use assets. Then thereafter, we are going to depreciate the right of use assets using either the lower of the lease term or the useful life of the asset. Then also we are going to account for the lease liability using the lease liability table. So basically, the question did not mention about that. So I just want to, improve on your understanding. So now, note, points to note, the lease agreement will be accounted for under the same principle. In other words, we are going to debit the right of use asset, and we are going to credit the lease liability. But in this situation, the amount we are going to debit as right of use asset is 520 and the lease liability is 650. That is the reason we have accounted for a profit so that the difference between the right of use asset and the lease liability will not be affected. So basically, we are going to continue to depreciate the asset, the right of use asset over the lease term or the useful life of the asset. I've covered that in detail. Also, we are going to account for the lease liability using the lease liability table, as I explained in our previous section, whether we are going to look at whether the payment is made in arrears or the payment is made in advance. So basically, under the sales and lease back, your concern should be how you can account for the sales, how you can account for the sales, the proportion that we are going to retain, that we are going to recognize as right of use asset, as well as the profit that we are going to account, the profit or loss that we are going to account for as a result of the disposal. So this is what exactly you need to know for the examination when it comes to the sales and lease back. I am more curious about the sales because I have already covered that list transactions separately in my lecture 3, in lecture 2 and 3, which we can account for the initial recognition as well as the subsequent recognition. So basically, you need to pay attention, especially when it comes to the calculation of the percentage retained. I'm going to repeat it again. We decided to calculate the percentage retained because initially 100% of the asset is disposed of to the buyer. Then we decided to go into lease agreement to have the right to use the asset. So we are going to have the right to use a proportion of the right to use the asset, but we are not going to get 100% right to use the asset anymore. We are going to get a proportion of it. So for us to get a proportion, we need to use the lease liability divided by the sales proceeds will give us the percentage retained. So for us to calculate the right of use asset, we need to multiply by the previous carry and value. Why? Because that is the value that the asset has been stated in the financial statement before the sale. So if after the sales, we are going to recognize it back in the financial statement, then we need to use that same carrying value to account for it. Because if we did not use the carrying value, the old carrying value, it means we can account for it as a revaluation, whether it's a gain or loss. Now, for example, if the current fair value is 1,000, as mentioned in the question, now if we are going to recognize the right of use asset as a proportion, let me do something. If we are going to recognize the right of use asset, if we are going to recognize the right of use asset as a proportion of the current carrying value, right of use asset as a proportion of fair value, then this will be the problem. Then this will result to problem. One, the fair value has increased to 1,000. Fair value increase in asset value from 800 to 1 million. Very important point. Now, if we are going to recognize using the carrying value, so it means 65% multiplied by 1 million, then therefore we are going to recognize 650, the lease liability, which is wrong because we have inflated the value of the asset. Another problem. Now, um, the initial value before the sale is 800. Now, if we are going to recognize the proportion retained based on the fair value, it means initially the value of the asset is not 800, it will be 1 million. Why? Because now the 25% is equals to the 250, which will give us the same 1 million. And this was not the initial value of the asset. The initial value of the asset is 800. So if we are going to calculate the right of use asset using the fair value, then this will be the problem. So for the examination, you need to know that you are going to use proportion of the right of use asset that will be retained as will be retained compared to the carrying value of the asset before the disposal. So basically, this is all what we need to know about the IFRS 16 for financial reporting. The only difference with financial reporting and the strategic business reporting is the lessor accounting treatment, but you don't need to worry about it for financial reporting level. So basically, thank you very much for your time and your understanding.